This is Johan Videos here. Something critical is unfolding in the silver and gold markets that demands your immediate attention. Before we dive deep, I need your engagement. Drop a comment with Johan Videos and your gold price prediction for February 15th. Where do you think we're heading? This helps me understand where this community stands and what analysis you need most. Let me break down what just happened. Silver closed at $131.41 on the Shanghai Gold Exchange. That's a 4% single-day surge. Gold smashed through to a new all-time high of $5,344.70 on COMEX futures. Mainstream financial media is finally starting to pay attention. The Shanghai Futures Exchange saw silver rocket up 3% to $130.95. Gold climbed 3.58% to $5,316.26. But here's what should make you sit up and take notice. Physical inventories on the Shanghai Futures Exchange, 35.9 metric tons withdrawn on Wednesday alone. Total silver inventories have now collapsed to just 58 metric tons. That translates to roughly 16,344,000 ounces. And here's the part that made me wake up at 3 in the morning when I saw the data. The Shanghai Gold Exchange massively hiked silver margins to 60%. Let that number sink in for a moment. 60% margins on silver in Shanghai, while inventories are collapsing and prices are exploding. If you don't fully grasp what that means, stay with me, because this is the kind of move that signals exactly what we've been discussing for years. The physical market is starting to override the paper pricing mechanism, and the institutions that control physical flows are responding in ways that reveal everything you need to know about what's happening beneath the surface. According to data released by the Shanghai Futures Exchange, silver inventories have been in a relentless drawdown. We're looking at total SHFE silver inventory that has declined to just 58 metric tons. To put that in perspective, that's roughly 16.3 million ounces. For context, global industrial demand for silver in 2025 alone was estimated at over 580 million ounces by the Silver Institute. What's sitting in Shanghai vaults right now represents about 2.8% of annual industrial consumption. 2.8%, and withdrawals are accelerating. 35.9 metric tons pulled in a single day on Wednesday. That's not normal restocking activity. That's not arbitrage normalization. That is physical offtake happening in an environment where premiums are already elevated and the exchange is raising margins to choke off speculative leverage. Now let's connect this to what's happening on COMEX. Gold futures hit a new all-time high overnight, $5,344.70. Mainstream outlets are covering it because it's a clean headline. What they're not covering is the technical and structural setup that got us here. Gold has been in a sustained uptrend since late 2024, driven by several powerful forces. Central bank buying, particularly from China, Russia, and several BRICS-aligned nations, persistent dollar debasement concerns, geopolitical fragmentation accelerating globally. The chart structure on gold is textbook bullish. Higher lows, higher highs, momentum confirming price action, volume supporting rallies. We're trading above the Ichimoku cloud on every meaningful time frame. RSI holding above 50 on pullbacks, MACD bullishly crossed. This is not a speculative mania driven by retail hype. This is a structural repricing of monetary metals in an environment where fiat currency confidence is eroding, and central banks are diversifying reserves away from dollar-denominated assets. But here's where it gets truly interesting. Silver is outpacing the stock market on a relative performance basis. The chart of silver versus the S&P 500, which you can examine in the circulating data, shows silver in a decisive breakout from a multi-year consolidation pattern that started way back in 2011. We spent over a decade in a brutal sideways to downward grind. During that entire period, industrial demand was building quietly. Mine supply was plateauing, and the paper markets kept silver suppressed through concentrated short positioning by a handful of major banks. That ratio bottomed hard and is now in a vertical recovery phase. Silver is outperforming equities decisively. Yet, and this is absolutely critical to understand, silver is still nowhere near its all-time highs. The nominal high from April 2011 was around $49 on COMEX. Adjusted for real inflation using methodologies outlined in economic works like When Money Dies by Adam Ferguson, or the Monetary Debasement Frameworks in Jim Rickards. Currency Wars, that number is closer to $70 to $80 in today's purchasing power. We are currently trading at $113 to $115 on COMEX as of late January 2026. Shanghai is pricing it higher at $131.41, but that's in yuan per kilogram. When you convert that properly, you're still seeing premiums to COMEX pricing, but we're nowhere near inflation-adjusted all-time highs. That gap represents both the opportunity and the tension in this market. So why is Shanghai hiking margins to 60% right now? Let's think this through systematically. Margin requirements are fundamentally a risk management tool. Exchanges raise margins when they perceive excessive volatility, when they want to slow down speculative positioning, or critically, when they're concerned about delivery stress on physical metal. The Shanghai Gold Exchange and Shanghai Futures Exchange are not like COMEX. They are physically settled exchanges. When you take delivery on the SHFE, you're pulling physical metal out of registered vaults. The exchange has a vested interest in maintaining orderly markets and ensuring that there is sufficient physical inventory to meet delivery obligations. When inventories drop to just 58 metric tons, and you're witnessing sustained withdrawals of 35.9 metric tons in a single day, the exchange is staring at a scenario where speculative long positions could completely overwhelm available physical supply. A 60% margin requirement is absolutely draconian. Normally, commodity margins on exchanges like COMEX or SHFE run anywhere from 5 to 15% depending on volatility levels. 60% means you need to put up 60 cents of capital for every dollar of notional exposure you want to control. That effectively kills leverage entirely. If you're a speculative trader running leverage, you're either forced to immediately close positions or post significantly more collateral. The intent here is crystal clear. The Shanghai Gold Exchange is trying to cool off speculative demand because the physical market simply cannot support the paper positioning at current inventory levels. This is not a sign of weakness in the silver bull case. This is confirmation that the physical shortage we've been tracking and warning about is absolutely real. It's intensifying rapidly, and the people managing the physical flows are taking emergency measures to prevent an outright delivery crisis that would expose the entire system. Let's discuss what drives that physical tightness. Solar panel installations globally are projected to exceed 400 gigawatts of new capacity annually through 2030, according to the International Energy Agency. Each gigawatt of solar capacity requires roughly 25 to 30 metric tons of silver in photovoltaic cells. That alone translates to 10,000 to 12,000 metric tons per year, over 320 million ounces just from solar applications. Add electric vehicles into the equation. Each EV requires half to 1 ounce of silver in electrical components and battery systems. Global EV sales are expected to hit 20 million units in 2026. That's 10 to 20 million ounces right there. Then you have 5G infrastructure build-out. AI data centers, where each hyperscale data center can require thousands of ounces of silver in circuitry and cooling systems. Defense applications requiring silver, consumer electronics, traditional industrial uses. The demand is staggering and accelerating. Meanwhile, global mine production of silver has been essentially flat to slightly declining since 2015. According to the United States Geological Survey primary, silver mine output peaked years ago and has struggled to grow due to declining ore grades, massive underinvestment during the long bear market from 2011 to 2020, and the critical fact that roughly 70% of silver production is a byproduct of zinc, lead, copper, and gold mining. When those base metals aren't economical to mine, silver supply contracts automatically. China is the world's largest importer and consumer of silver. According to data from the Silver Institute, China accounts for roughly 1/3 of global industrial silver demand. They're also strategically positioning in metals as part of their broader de-dollarization strategy that's been underway for years. We've witnessed Chinese export controls imposed on critical minerals like gallium, germanium, and rare earth elements. We've seen them systematically build strategic reserves in copper, aluminum, and other industrial commodities. Silver fits perfectly into that strategic playbook. It's a dual-use metal, both industrial and monetary. If you're China and you're preparing for a world where the dollar's role as global reserve currency diminishes, where supply chains fragment along geopolitical lines, and where technological competition with the West intensifies dramatically, you accumulate silver aggressively. The drawdown in SHFE inventories is not random market noise. It's entirely consistent with strategic offtake by entities that fully understand the long-term supply-demand imbalance that's coming. Now let's pivot to the broader macro environment. Gold hitting new all-time highs is a powerful signal that something fundamental is broken in the confident structure of fiat currency systems. Central banks globally have been net buyers of gold for 15 consecutive years, according to the World Gold Council. In 2024 alone, central banks added over 1,000 metric tons to official reserves. That buying pace has not slowed whatsoever in 2025. Russia, China, India, Turkey, Poland. These are not speculative buyers chasing momentum. These are sovereign entities with massive resources, systematically diversifying away from dollar-denominated reserves. The old narrative that gold pays no yield used to be the reflexive dismissal from mainstream finance commentators. But when real interest rates, calculated as nominal rates minus actual inflation, are negative or barely positive, and when the risk of currency devaluation is rising dramatically due to unprecedented debt levels and continued money printing globally, gold's lack of yield becomes completely irrelevant. It functions as a store of value in a world where paper assets are being systematically debased. Silver follows gold's lead, but with a critical twist. Silver carries the same monetary history. It was actual money for thousands of years across civilizations. But silver also possesses the industrial demand profile that gold completely lacks. Gold is largely inert in industrial applications, outside jewelry, and some electronics. Silver is consumed at massive scale. It's used in applications where it cannot easily be substituted due to its unique properties. Superior electrical conductivity, highest thermal conductivity of all metals, reflectivity for solar applications, antibacterial properties for medical uses. That dual demand profile means silver can dramatically outperform gold during a monetary crisis that coincides with an industrial boom. And that's precisely the setup we have right now. We're in the middle of a global energy transition that requires absolutely massive amounts of silver. We're in a technological arms race involving artificial intelligence, quantum computing, advanced semiconductors, all of which require silver. We're operating in a geopolitical environment where nations are actively hoarding strategic resources. And we're functioning in a monetary environment where central banks are buying gold hand over fist. And investors are finally waking up to the reality that silver is dramatically undervalued relative to its fundamental drivers. The technical picture on silver strongly supports this thesis. The silver to S&P 500 ratio chart, which prices silver in S&P 500 index terms, shows a decisive breakout from a 13-year base pattern. That base was formed during a brutal period where silver was completely ignored by mainstream investors. Industrial demand was building quietly beneath the surface. Paper shorts on COMEX systematically kept a lid on price discovery. The breakout that began in late 2024 and has continued into early 2026 is not a false move or head fake. Volume is confirming the price action across multiple exchanges. The move is broad-based across COMEX, the London Bullion Market Association, Shanghai Futures Exchange, and Shanghai Gold Exchange. We're witnessing backwardation episodes, which are periods where the spot price actually exceeds the futures price. This is highly abnormal for silver and directly indicates physical tightness in the market. The Commitment of Traders report from the commodity. Futures Trading Commission, which tracks positioning on COMEX futures, has shown a steady reduction in the concentrated short positions held by a small number of bullion banks over the past 18 months. That unwinding of entrenched short positions removes a structural headwind that artificially suppressed silver prices for years. When you combine reduced paper supply from fewer shorts with dramatically increased physical demand and rapidly declining inventories across global exchanges, you get precisely the explosive price action we're witnessing right now. But let's maintain balance here and acknowledge the risks. There are legitimate reasons this rally could stall or enter a consolidation phase. First, a 60% margin hike on the Shanghai Gold Exchange is specifically designed to slow down speculative momentum. It will work in the short term. Traders who are running significant leverage will be forced to reduce positions immediately. That could trigger profit-taking and a pullback in Shanghai prices, which could ripple back to COMEX through arbitrage mechanisms. Second, if global economic growth slows significantly, driven by recession fears or credit contraction, industrial demand for silver could soften temporarily. Silver is inherently more economically sensitive than gold precisely because of its large industrial demand component. In a deflationary scare scenario, silver historically gets hit harder than gold in the short term. Third, central banks do not buy silver the way they systematically buy gold for official reserves. Silver lacks that same level of institutional support from sovereign buyers. If we witness a broad risk-off move in global markets, with equities selling off sharply, bonds being bid aggressively, and dollar strength returning, silver could correct alongside other industrial commodities. Fourth, the United States Federal Reserve's policy stance absolutely matters for commodity pricing. If the Fed pivots to a more hawkish stance than currently expected, if real yields rise substantially, if the dollar strengthens significantly on safe haven flows, that puts downward pressure on all commodities priced in dollars, including silver. And fifth, geopolitical risk is a double-edged sword that cuts both ways. If major tensions ease unexpectedly through trade deals or diplomatic breakthroughs, the flight to safety bid in precious metals could diminish rapidly in the short term. These are all real risks that must be acknowledged. This is absolutely not a one-way trade with guaranteed outcomes. Financial markets never are. But here's the critical counterpoint, and this is where the news from the last 24 hours becomes absolutely vital to understand. The margin hike and the dramatic inventory drawdown happening in Shanghai are not bearish signals for the long-term fundamental thesis. They represent confirmation that the physical market is under genuine stress. A margin hike of this magnitude is fundamentally a supply-side response to excess demand that cannot be met. It's the exchange effectively saying, we cannot allow open interest to continue growing at current inventory levels because we legitimately might not be able to deliver physical metal to contract holders. That scenario is ultimately bullish for physical holders. If you own physical silver bars or coins in your personal possession, you are holding the actual asset that the market is desperately scrambling to secure. The paper market can manipulate price in the short term through leverage and forced liquidation, but it absolutely cannot manufacture physical metal out of thin air. The industrial users, including solar panel companies, electronics manufacturers, defense contractors, and technology firms, they need the actual physical metal. They will pay whatever price is necessary to secure supply. The arbitrage spread between COMEX and Shanghai pricing will widen dramatically if physical tightness persists and intensifies, and that widening spread will inevitably pull COMEX prices higher over time through market forces. Gold breaking out to new all-time highs provides a powerful tailwind for silver. When gold is breaking major resistance levels and making new highs, it validates the overarching thesis that we are definitively in a monetary metals bull market. Silver has historically lagged gold at the very beginning of these major cycles, and then dramatically outperformed later as the move matures and industrial demand layers on top of monetary safe haven demand. We witnessed this exact pattern in the 2000 to 2011 precious metals bull market. Gold led consistently from 2001 through 2008. Silver started catching up meaningfully in 2009, and then silver went absolutely parabolic from late 2010 through April 2011, ultimately outperforming gold on a percentage basis by a massive margin. The current market setup rhymes closely with that historical precedent. Gold has been leading decisively since 2022. Silver is just now starting to catch up and show relative strength. If historical patterns hold, and as the legendary trader Jesse Livermore detailed in Reminiscences of a Stock Operator, markets are fundamentally driven by human psychology and behavioral patterns that repeat across generations. We could be entering the specific phase where silver begins its period of dramatic outperformance. The supply-demand fundamentals supporting silver have never been this constructively bullish in modern history. The Silver Institute's most recent comprehensive report projects structural supply deficits continuing persistently through the end of this decade. Mine supply is not responding to higher prices in any meaningful way. Even with substantially elevated prices, it takes 5 to 7 years minimum to bring new silver mines online from discovery through permitting to production. Existing operating mines are dealing with steadily declining ore grades as the highest quality deposits are exhausted.